Hey guys, this is Chris Mincola with the Mincola Group over at West USA Realty, and I'm doing our weekly housing market update. And just wanted to start real quick with some of our stats from July, kind of do a quick review on that, and then get through some of the numbers. So our residential sales in July were 59.62. Our median sales price was 453.5. Again, this is all hyperlocal Phoenix metropolitan area. So 453.5 was the median sales price. The average sales price was 546 and some change, and the average lease price was 2373, 2,373 a month was the average lease price. Okay. Some overall stats. We're at 30 right now. We're currently right now this week. We're currently at 39 closed days on market. We're at a 3.54 month supply, which is a little bit of a dip. Last couple of weeks have been around 3.7 to 4 ish. So we've got a little bit of drop there, which I'll talk more about. Absorption rate is at 28.21%. And then so it's kind of a balance, more of a balanced absorption rate. And then the average list price is 686, and the average sales price is again, for right now, where we're at this week, is at 580, the average sales price. The list to sales price ratio is 97.25. Usually, we like to see that a little bit higher, like around 98.2-ish, right in that range, but certainly not horrible. And again, going into more of a balanced market, we're probably going to see that kind of adjustment happening with, the lottery market and insanity market that we're in versus where we are today, and people kind of adjusting prices and whatnot, which I'll get into more. So looking at the overall picture, kind of look really quick at looking at a bird's eye view from the national standards. The builders right now are concerned a little bit about sudden pullbacks in new home market. A lot of people are canceling contracts and whatever, and I think this is mainly due to the fact that number one, there is some media hysteria, which I am going to get into in greater detail in another video. But basically, just even if you look at the last 7 years, at every point they've kind of raised the chicken little sky is falling, we're going to have another crash thing, which, remember, 2008 was caused by the housing crash. That recession was caused by the housing crash. We're in a recession now, but it's caused due to other factors. It has nothing to do with the housing market. So at this point, we've got different lending practices. People have a lot more equity, and there's still, even though there's higher supply right now across the board and in the Phoenix area, we were looking at basically over, about triple in the Phoenix area, where we were back then versus now. So we're just going into basically a balanced market. But because there's this, hysteria, and then, yes, higher interest rates does play into it a little bit. But there's more options for people, right? There's more supply out there in resale homes. So there's a little bit more options out there, to the point to where, somebody was buying a new home, they may look at something. I mean, we've got people like this right now where they're looking at, wait a minute, if I could get a home for $50,000 to $100,000 less, maybe with a bigger yard for the kids and pets, maybe put a pool in, or it already has a pool, a little bit more room for all that, maybe even get a little bit bigger house. Yeah, it's a little bit older home, but it's not ancient. So, or it's been renovated. Maybe I'll go that route. So people are looking at that, where in some cases, again, they may be looking at paying, 50 to 100 to $150,000 more, but not having to do some of these extra things in the house. So but the builders are concerned about this. They certainly haven't overbuilt like they had done back in the previous crash, nationally and in our area, for the Phoenix area. But right now what they're seeing is about 1 in 5 home builders reportedly reduction in their prices in the past month. They're offering a lot of incentives, which we've already talked about Again, this is nothing new when we have a fluctuation in supply and demand. And the average cost to build a new home has jumped 35.7% since January of 2020. And an expense that gets, passed on to buyers, of course, according to the Commerce Department. So these are all obviously factors that everyone is looking at, including the builder. So we may see, not that they're not going to finish your home if you're having one built or whatever, but starting new projects, they may kind of have a little bit of a cooling off period there, possibly. But again, overall, believe it or not, nationally, we're about $200,000 down from where we probably should be in having supply. So that sounds crazy, but that's kind of the overall national stat. But because remember, they have to kind of build ahead in order to keep up with the current and future demand. Okay, it's not just, oh, now there's demand, now we're going to open up a community. Obviously they have to do a lot of stuff up front in order to get that community started. So permits and all that, and have the supplies they need, and workers also. So permits, everything. So here's another article from Inman News. New home starts fall sharply. The whole housing sector is in a retreat. Okay, so we see a little bit of a fluctuation here in newly started single family projects, fell from a seasonal adjusted annual rate higher than 1 million in June to just over 900,000 in July, according to new numbers from the U.S. Department of Housing and Urban Development. That 10% drop is the steepest so far this year, and continues a sudden and steady downturn that has seen the rate of new single family home housing starts plummet by more than 20% since January. So from the sales perspective, things are likely to get worse for builders before they get better, according to chief economist at research firm Patheon. Okay, so keep in mind, again, there may be a little bit of a concern there, but again, that's from a builder standpoint. That doesn't mean that people aren't still buying resale homes, right? And keep in mind, when we're talking about new inventory, new inventory really is about new homes. Okay. Yes, resale homes are counted in the overall numbers out there, but it's really not new inventory, because a lot, or at least around half or almost half of those people are probably going to be buying a home themselves once they sell. Okay, so there's kind of that cancellation there, that cancellation effect, unless it's just a second home or an investment property, or in this case, a new build. So now, obviously, mortgage rates do have some effect in affordability. For about 1% difference in a home, or in a mortgage rate, you're probably going to pay about 10% more in a payment. But keep in mind, if people need to buy a house, in other words, what usually drives that? Household formation, not always two people coming together, but sometimes it's single people. But when somebody or a couple need to buy a house, and mainly, that's what drives the market, is, families growing, people getting married, whatever, are coming together, and having household formation, that really drives the market. So when, I'll talk more about this in the other video I'm going to be making on the overall craze and hysteria out there and what the real numbers are, in a separate video. But it's really important to understand that that's what drives the market. So when we see that the demand maybe drops a little bit due to affordability, that's understandable. But we also have to understand, again, we're kind of really in balanced numbers, which I'm going to talk about here. We're kind of really into balanced numbers. And when there is inflation, which we have, inflation, they say 8.5% now, down from 9.1. If you were to, calculate it with the old numbers, it would be, well into the double digits. Probably closer to 12-15%. But right now, the demand for mortgages hits lowest level in more than 20 years. Okay. And again, it's kind of a perfect storm right now. Think of it like this. Um, the usually the slowest months of the year, depending on what part of the country you're in, are going to be August and September. For us in Phoenix, usually July, August are pretty slow. Why? Because people are on vacation. They've already maybe sold their home and moved on in the spring, right when school or right prior to school or right after school let out. Then they go on their vacations. A lot of management, mid-level management, upper management, they'll take their vacations in August or September because you got Labor Day in there. You've got, kids are back in school. So maybe the adults, want to go on vacation without the kids in tow or without the kids being in places they want to go to. It just kind of the ebb and flow of, the way vacations work, if you kind of analyze it and break it down. So looking at when school's in and out, looking at when people may take their vacations, looking at seasonal type of things like that, looking at the holidays, looking at whether or not we're talking about retirement communities, all that falls into play. But overall, usually August, September are slowest months. And then we have some of the biggest closings numbers done right before the end of the year, in October, November and December, as far as actual closings. Once they go under contract, it takes 30, 45, maybe 60 days to go to close through an escrow period. So keep that in mind, So for us here in the Phoenix area, it's kind of a perfect storm. We had all this influx of new inventory that came in around, around April. And then we had, our vacation and super hot season where nobody even wants to really go outside unless they're in a pool or they're traveling, and on vacation or maybe going up north to colder part of Arizona. And then you've got, people that are going back to school this month. For us, people started back in school early August, mid-August. So there's kind of that getting adjusted to going back to a new routine with school, right? So just all that just kind of slows everything down. Then you throw the extra inventory in there, a little bit less migration from places like California due to the pandemic migration. And then you throw in the higher interest rates, and then you throw in the media hysteria for clickbait to make money on the hysteria out there, and then it becomes this kind of perfect storm, right? So let's just keep that in mind, and let's think balance. In other words, we're in a balanced market. We're in kind of a seasonal flux, and yes, interest rates will affect a certain percentage, but people are going to buy a house. They're going to buy a house. They got to pay rent or they got to buy a house, right? So it makes more sense to buy a house. Certainly have that equity gains, those tax benefits, buy down that mortgage every month versus throwing money out the window, unless they're just kind of in a flux situation where they're going to be kind of moving in and out and that sort of thing. So all right, so as far as the interest rates go, requests for refinances were down, of course, because interest rates are up, even though interest rates are 4, 5, 6%, kind of historic lows even in that range. So we just kind of got drunk off that 3%, range that we had last year, and the housing lottery of getting 20, 30, 40%, depending on what part of the country you're in. We had around 32%. So we just got drunk off all that, and forgot that we're not going to hit the lottery, the housing lottery, like we did last year every year. Okay, we just got to come back to earth and understand balance. We're in balance. So requests to refinance were down 5% week over week, and 82% from a year ago, the lowest level since November of 2000. Duh. Okay, so interest rates are up. No, nothing extraordinary there, and that's where we are. And we're in a seasonal flux and inventory surge and all that. So the 30-year fixed rate conforming rates, the overall rate average this past week was up a little bit, 5.47%, up from 5.45% the week before. But with points decreasing to 0.5 from 0.8. So, and then it goes on to talk about each one. I'm not going to get into each one, but that was kind of the overall average. Then you look at the Brownford Market Index. The Brownford Market Index is something that we use when we talk about the housing market and understanding the overall point of where we're at. So from 90 to 110 on the index chart, 90 to 110 puts us in balance. Okay. That puts us in the balance range. If we're over 110, we're in a seller's market. If we're under 90, we're in a buyer's market. Okay. So right now, the overall index is 108.9, 108.9. So that means technically we are in balance. Okay. We are in balance overall. The demand is at 79.3, which overall is under that 90 mark, right, by about 11 points. They're at the middle mark of 100, down from there about 20 points. And then we're at supply of 72.8, 72.8. So that's obviously under also that 100 mark by about 28 points. So when the supply number, and that supply number was all the way down in the 20s, low 20s, when we were in the insanity market, and the demand was, way over where we are now, into the 90s. So when those two numbers, when the demand and supply numbers balance up or come together, that means we're in a balanced market. Well, supply is at 72.8 and demand is at 79.9, and the overall market index is at 108. And again, between 90 and 110 is that balanced market. So they're pretty darn close, and the overall average tells us we're in a balanced market, guys. So what we're doing right now, okay, get a little woosa, a little calm, stop listening to the media hysteria. They've been wrong all the time. They're wrong all the time. I'm going to make a whole nother video and we're going to get into this. And I'm going to have charts and everything and a little bit of history for you, and we'll break it down. But basically, we're in a balanced market. Okay. Here in the Phoenix area, this is for the Phoenix area. We're in a balanced market. Okay. I went through last couple of market updates. I went into the local data on the news and where we are in the economy here in Phoenix. We're doing just fine. We're in a normal market. So, we just got to kind of come to grips, get a grip, kind of come to grips with that. Uncle Bob may tell you the sky's falling. The guy on the local or national news may tell you the sky is falling. It's not falling. Okay. We're just coming back into balance more than the insanity market. So, right now, that's where we're at. And, we haven't been in a balanced market since February 17th of 2015. That's how long it's been. February 17th of 2015. We haven't been in a balanced market since then. So right now, the cities that are on the index that are in a buyer's market are Surprise, Gilbert. Okay, these are actually in a buyer's market on the index. Surprise, Gilbert, Tempe, Maricopa, Litchfield Park, Buckeye, Queen Creek, and Santan Valley. So if you're having a listing in one of those areas and you're wondering, why isn't it selling faster? Well, you're in a buyer's market. So these are the areas you could probably get, a better deal in as a buyer. And then the cities that are in a seller's market in our local area here in the Phoenix area is Fountain Hills, Paradise Valley, Scottsdale, and Cave Creek. Those are in a seller's market. Those are going to have the strongest areas for sellers. Now, on the overall listings, let's talk about inventory. On the overall listings, we are in our inventory and what that looks like. We are in, let's see, fewer than 10,000 new listings in the last 28 days. So what we're starting to see is a little bit of a decrease. Okay. just taking you back a little bit when the surge in uptakes started happening. We had in March, we had over 10,000 new listings come on the market. In April of this year, in April, we had over 10,000. And in May, we had 11,600. And in June, we had 12,410 new listings. Okay. So and in July we had almost 11,000. We had 10,800. So right now in August, we've got 5,718 new listings so far this month. So we're not going to be anywhere near the numbers keep going where they are. I mean, we're already, at pretty much at the end of the month. We're not anywhere near where we were in the last, 2, 3, 4 months. So that's going to be a big change in our inventory. Hopefully some of the inventory that's kind of been sitting there with the price adjustments and stuff, those will start getting eaten up by the buyers and kind of go on from there. So that's a big deal. That's a big change. That's a big shift. So we'll see where that takes us. Probably will help us to stay in a balanced market. Are we going to creep back up, anywhere near where we were? So far, probably not. We need to eat up some of that inventory. Before we had all that craze in the market, I mean, we were down in numbers of, 4,500, 5,000 in inventory. So we're still pretty high. The new listing peak, the new is let's see, hang on a second, I just want to make sure I've got my microphone here correct. Sorry about the noise in the background. I don't know what's going on out there, but anyway, new listing peak, for every 4 weeks we had 12,200. That was our new listing peak. In a 4-week period was 12,246. So we're nowhere near that now with, 5,700 in the month of August is almost over. And the influx basically of this new inventory started around April 21st to be exact, where we really saw a surge in inventory coming in and just kind of sitting there a little bit longer. Of this year. So 4-week count, we're down in the last 4 weeks. We're down year over year, 2.7% year over year. And then, as far as our weekly total, we're down 9% year over year. So that's a big difference. Weekly total being down, 9% year over year. And then the areas where we've seen the heaviest fall in our supply fall. All right, not to be confused with skyfall, but supply fall. We've got Fountain Hills, Cave Creek, Maricopa, Chandler, Glendale, and Tempe. Okay, so those areas have seen the biggest supply fall. And then, as far as buyer demand and what's going on under contract, we're actually seeing where that is starting to trend back up. So it was down, way down as far as properties going under contract. It had really dropped quite a bit. Now we're, up in the, up near almost, let's see, 77.5 range. Properties going under contract this week. And for the month of August. So that's really good. Newly accepted contracts in the last 7 days, that's 1,803. That is up quite a bit. So we're starting to see this trend. You see if it continues, where we're seeing more properties go under contract, a little bit less inventory. And I think people are, again, coming out of the vacation and just maybe starting to come out of the school fog, and vacation fog of the summer, and the issues that go on seasonally like that. And then people start to realize, historically we're fine. We're in a balanced market. The interest rates aren't that crazy. You can get incentives from builders or from on a resale sale. You can get concessions to actually get the rate down, to buy the rate down through the closing costs. So um, again, we kind of saw the biggest dip in properties going under contract around June 12th. And now we're seeing definitely a surge in August of properties going under contract more. And this week it's been pretty amazing what's happening. So um, the lowest we kind of had, for properties going under contract were back on July 3rd, where we kind of really saw a dip, and that was at 1429, 1,429. So, guys, just some other quick notes here that I wanted to make sure I shared with you was, you know, we had the let's see, 60% more homes are available this year over last year at this present time, even though we're starting to see this kind of trend in supply and demand. Okay, maybe a little shift there. And then 1/3 less homes selling, 1/3 less homes selling uh, at this point than we were last year. But again, we're starting to see that kind of trend differently. So we'll see how that goes. And then there are over 4,000 homes per week. Over 4,000 homes per week are reducing their price, and the median price reduction is $15,000. So and again, that could vary by area, house, type of home, area, community, and city and all that. So, we can of course get you some more numbers if you want the info on where we are there. So guys, make sure you stay tuned. Check out our email, subscribe. If you want to get on the subscription list, make sure you send us your email address. Also, always check us out on YouTube and Facebook. And Instagram, and we'll be uploading our videos there. I do have another video coming up on the rental market, and I'll also have one coming up that will get more into detail about the what's really happening even nationally and at the local level, a little bit more in detail, and media hysteria that's going on and what the reality is there, and how I haven't found many cases yet where they're correct in their assessments. I mean, they were even way behind the curve on whether or not we were going into a recession. So, two quarters where we're down, that would be a recession, and that's where we are. So, guys, keep that in mind when you're hearing the hysteria out there. Remember, they make money on clickbait. That's where they make their money today. So if they said, hey, we're in a balanced market, maybe not too many people are going to click on that, but sky is falling, we're crashing, and all that. People click on that. Oh, everybody wants to know, where they're at with their real estate values and stuff. So guys, keep us in mind. If you have any questions, you can always reach out to us, 480-788-8569. Check us out at MancolaHomes.com, MancolaGroup.com. You can always email us at home@MancolaGroup.com, and we will see you next time, and I'll make sure we get those other two videos out ASAP. Thanks.